Hey guys, Akil Stokes here. Welcome back to another episode of the Trading Coach Podcast. In today's episode, I'm going to share with you my most important trading indicator and of course tell you exactly why that is. Now, before we hop in, this is another video episode, so make sure if you're listening on audio only, head over to a video platform like Spotify or YouTube or whatever other podcasting apps share the video versions of this as well. I'm going to be heading to the charts for a little bit to show you the indicator, so it's best that you watch that way. But of course, for the audio only crowd, I'll do my best to kind of verbally explain what's going on. So the subject came from a workshop, right? Jason and myself just wrapped up a 3-day trading workshop. It was an amazing experience. A great closed door group of traders with some great questions. Far too many questions for us to answer in such a short period of time while teaching the things that we wanted to teach. And one of the questions that came up as we were working through an active trade of ours was the ATR, the average true range, which, surprise, surprise, is my most important indicator. Now, what's very important to understand is that when I say it is my most important indicator, it doesn't mean that it has to be your most important indicator. Something we had to discuss during the workshop was the idea of best in trading. What is the best strategy? What is the best entry? What is the best asset class? What is the best indicator, right? There is no best, right? Trading is awesome because it's really unique, right? You have a chance to create a system, a strategy, a plan around you and what you personally value, right? Whether it be fundamentals, whether it be technicals, whether it be trend continuation, whether it be counter trend, right? It is 100% up to you, and you can be wildly profitable no matter what you do. I had a trollish comment the other day on one of my videos. I think it was the consolidation video where I was talking about Gartley patterns, and I've gotten this a lot over the years, and they're saying, what is this wild space astronomical nonsense that this guy is talking? This doesn't work. So I had to remind this trader, if they ever spent the time to read the book Market Wizards by Jack Schwager, where he interviews the top traders of all time, there was in fact a trader in that book who used astronomy, used the almanac to become one of the best traders of all time. So take that. Haha, you look like an idiot. More of an idiot than you already do. But the truth is, there is no best. It's very similar to like if we were going to walk into an ice cream shop and I asked the owner, hey, what is the best flavor here? Well, it's different, right? The owner may like strawberry. I may hate strawberry. You may like vanilla. She may like mint chocolate chip, right? There is no general best. And what we want to teach as traders, or I guess as trading coaches, is that although there is no best and everything can be delightful, there are best practices on how to surround your trading, meaning approach it like a business, risk management tools, trading plan, if-then syntax. That would be, I guess, similar as I'm running with this ice cream analogy of there is no best flavor, but you're probably best eating your ice cream out of a cone or a cup versus your hand, like I don't know, or with a spoon versus a fork or a knife. You get what I'm saying. So there is no best. So I don't want you guys being blinded when I do this podcast episode thinking like the ATR is the say all be all indicator just because it's my most important one. You can choose whatever indicator you want. What's funny is that although I've chosen the ATR as my most important indicator, it's actually not an indicator that I use in any of my analysis as far as like predicting levels, predicting trades and entries, right? The reason it is important is because I use it in all of my trades for my stop loss. Now, before we get into more detail about that, because we're going to head over to the charts and look at it, I want to talk a little bit more about indicators in general, because I talked about making trading your own, right? If you're going to be a technical trader, there are many ways you can go about it, but one way is choosing which is going to trump the other. Are you going to use price action first and your indicator to complement that? Or are you going to be more of a mechanical trader where you use strictly an indicator? And again, neither one is wrong. My personal philosophy is I'm a price action trader, so I use price action first, and then I use my indicators to complement it. But I've also built plenty of indicator-based strategies where the indicator is what gives me the signal, and maybe price complements that signal on the indicator. What matters most when it comes to choosing an indicator in general is that you know what your indicator is indicating. And it's weird that I have to say that, but believe it or not, there are so many people that watch videos, read books, whatever they do, but they just throw an indicator on their chart. They don't actually know what their indicator is doing, but it just sounded cool or because everyone else is using it, so they do the same. So make sure you understand what your indicator is indicating, because after all, that's what you're building your plan around, or that's what you need it to complement. 2, don't assume that the default version of your indicator is the best. And what I mean by the default version is this. When you head over to a price chart, you're going to select your indicator and it's going to have settings that are already pre-programmed in there because you got to start somewhere. Many of us assume that because these are the default settings, they are the optimal settings, they are the best settings. That is not true. Remember, your trading plan and your trading rules are specific to you. Your approach is specific to you. Your indicator needs to work for you, meaning that it needs to tell you what you need it to tell you. And sometimes you have to change the settings in order to get that correct signal. So if you're someone that's been trying out indicators or a magic strategy you heard about and you're like, it doesn't work, the indicator's broken, blah, 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 blah. Don't jump to that conclusion until you kind of filter and tweak and tinker with the settings to see if you can get it to show you what you need it to show you. So now back to the ATR. So the ATR is important to me. I have it as my most important indicator, mainly because it is the only indicator technically that I use in every single one of my trades. Again, I'm not too indicator based. Typically, you'll see me with an RSI on my chart, and that's about it. There's an ATR on my chart, but it's hidden at the bottom because I don't need to see it. I just need the number. The RSI is useful in some of my trading strategies, whether I'm looking for overbought, oversoldness, whether I'm looking for diversions, whether I'm looking for that weird RSI swap and reversal thing that we haven't quite named yet. It is important, but there are many other techniques and strategies that I also trade where the RSI is irrelevant, meaning I can get involved in trades without it giving me whatever signal it needs to give me, or in some cases without even looking at it. The ATR, however, is present in every single one of my trades because I use it to project my stop loss. Now, what is the ATR? The ATR is the average true range. And what that means is essentially it is the average movement of the market over a set period of time. So you take like the high of a range, the highest price, the low of the range, the lowest price over a certain amount of time. That's going to be your period. So the default, I believe, is 14, and it takes that average range. And what that means is that it is a volatility indicator, right? It tells you how volatile the markets are. The larger the number in the ATR, the more volatile the markets are. The smaller the number in the ATR, the less volatile it is. And this is important to me in my stop loss because I want my stop loss to work with the volatility. And let's hop into the charts and show you what that means first. So first and foremost, we have a blank chart. We're going to load up our ATR here. We're going to go to our indicators. I'm just going to type in ATR. It will come up as average true range, right? You can see it at the bottom of my chart here, this squiggly wiggly. Again, I don't actually use the graph for anything at all. I typically just go over to my side deal here, go to my data screen and look at the number, but you can have it there if you want. Now, as you mentioned, the default setting of the ATR is going to be 14. I actually have mine a little bit quicker, and again, this is my personal preference, to 7. And what that does is this. Instead of the average true range being calculated over the last, I'm going to do a daily candle here, or daily chart here, just to make it easier. Over the last 14 days, it's calculated over the past 7 days. And what that does is it gives me more of a, not a real-time view, but a more present-day look at what the volatility is. So, for example, if I'm looking back 14 days, there can be crazy swings a week ago that made the ATR increase. However, price action this week could be back to normal. Well, I'm still going to have that bigger than normal ATR, even though all of that crazy movement was a week ago. 7 days gives me a look at the last trading week or the last 7 days of trading, which gives me a much more kind of look at what's happening more recent. So like a recency bias, that's the word that I was looking for. Again, you can make it 5, you can make it 7, you can make it 13, 21. It all depends on what type of scope or time period you want to look at as far as making that decision about volatility. Now, how I personally use the ATRs with my stop loss is this. So let's say I'm entering a trade right here. This is not an actual trade. I'm just pretending to do this. I got a white screen on. I got to change all my graphics. I'm used to the dark screen, but I want to try something different. Let me change my crosshairs as well. So I got a trade right here where I'm looking to get short. And I want my stop above the previous high right here. Well, the question is, well, Akil, how do I place my stop there? And we had a great discussion in the workshop about this where it's like, hey, when we're placing a stop loss, we need a reason behind our stop loss. We need a reason behind everything we do in trading, but specifically when it comes to our stop loss, we need a reason behind that stop loss. And think about that for a second. How do you place your stop loss? Is it 1 pip? Is it 5 pips? Is it 3 pips, right? Those aren't wrong answers necessarily, but make sure you ask yourself the question, why is it 1 pip? Why is it 5 pips? Why is it 3 pips? Why is it here? Why is it there? And if you can't answer that question, you probably need to rethink that stop loss strategy. And that's something that many newer traders do. We just do random things in random locations, right? Just like psychological numbers where it's like, oh, I'll get my stop loss at 106 even. Well, why'd you choose that? Because it sounds good. Or 107 even. And going back to like big banks and institutional trading and manipulation, it's pretty predictable. They know that, and you can be kind of stop hunted and all the fun stuff that we complain about. Again, if you listen to that podcast, I said manipulation is present, but it's not necessarily a negative. It's just the way the game is played. And as traders, we need to understand the game and not put ourselves in those situations. So just make sure you have a reason to do what you're doing. So going back to the chart here, what I want to do is this. I want to take a look at the ATR of my most recent candle. So this candle is happening right here. This is going to be my most recent candle right here. And I'll hover my mouse over it. You can see it down at the bottom of your screen as well. But on this candle, the average true range was 95. So what I'm going to do is I'm going to take some type of multiple of that average true range. It could be 0.5 times, it could be 1 time, it could be 1.5, it could be 2. Again, these are decisions that you'll have to make. And I'm going to get my stop loss, that amount above the high, right? I'm not accurately dragging this on here because I don't feel like doing math right now. My brain is fried from the workshop, but you get the point. This would be blank ATR above the high. So what is the reason for that? What is the justification? Well, it gives me consistency. It's important to understand that all markets move differently. So if we're just speaking specifically the Forex market, right? Different pairs move differently. Some pairs are much more volatile than others. Different time frames move differently as well. So for example, this was 95 here on the euro dollar, which the euro dollar typically has kind of a normal ATR, I would say. If we were to go to, watch this, the Aussie dollar, we should have a much smaller ATR. So Aussie dollar, same time frame, we're on the daily chart. We should have a much smaller ATR. If I hover over here, look at that. The ATR is 58, much less. Now, if I'm going to do my same ATR stop loss, I'm entering right here for whatever reason again, and put it 90, whatever, let's say 1 ATR above the high, I'm going to have a much greater range than I probably need to on this pair because the volatility is smaller. Vice versa, if we go to something like the pound yen, which traditionally has a very large ATR, let's see what this one is. There we go, 220. All right, so euro dollar in the middle, 95. Aussie dollar is 58, 60. This one's 200. At the same time, if I take that Aussie dollar ATR, which was 60, and I put it right above the highs here on the pound yen, I may not have enough breathing room, right? And we could do the same thing from time frame to time frame. The pound yen is 220 ATR here on the daily. If we were to go down to the hourly and take a look at this, our ATR is going to be about 45. So do I still want a 220 pip ATR on a much lower time frame? Probably not. And that's the problem with having kind of a set stop loss, right? If I'm going to say, hey, my stop loss is going to be 10 pips above the high. Well, 10 pips above the high on a 5-minute chart may be a-okay. 10 pips above the high on a daily chart is going to be right here. And that's not nearly enough breathing room. So this is why the ATR is cool, because it is dynamic. Instead of having we don't want to have a set stubborn stop loss that is exactly the same across pair and across time frame, because you see there's so many different fluctuations here. But we can have a set stubborn ATR based rule, and we can stubbornly stick to that rule, which is what we want to do as traders, as rule following traders, right? Yet it's going to be dynamic to both the pair and the time frame, right? Does that make sense? So in a way, we have consistency with our method of stop loss, but it's still going to give us the appropriate amount of breathing room which is dynamic to the actual trading situation that we're in and the market conditions that we're in here. Meaning that if it's a higher ATR, meaning it's a more volatile time, we're going to give ourselves a bigger buffer zone. If it's a smaller ATR and a less volatile time, we're going to have a smaller buffer zone. So I hope that made sense. Believe it or not, I was worried about making this video because I wasn't sure how I was going to get a good amount of time out of this subject. But lo and behold, the power of talking, Akil made it 15 minutes or so. And this was very fun. So if you have any other ideas or any other topics that you want me to discuss, as always, leave it in the comment section below or send me a DM on the social media outlets. And before you go, hit that like button, share this on your socials, and rate and review if you haven't done so already. Before you go, I don't plug this enough, but we are trading coaches. We have an amazing platform called Tier 1 Trading, featured in Forbes magazine as a leading innovators of trading education. If you're ever interested in learning how to trade, check out the website, www.tier1trading.com. I recommend starting with the 14-day risk-free trial membership. It gets you on the platform. You're allowed to interact with the community. You can check out the live sessions and you can try out a few courses and make sure it's the right fit for you before you make any type of commitment. So I look forward to seeing you there. And until next time, plan to trade, trade your plan. Take care.